Investing can frequently be simplified into a handful of straightforward guidelines that everyone may use to make money. So achieving success might involve both doing and not doing things. In addition, the procedure is complicated by our emotions. Although everyone is aware that you should buy low and sell high, our disposition frequently causes us to do the opposite. So, it's important to establish a set of golden rules to help lead you through the challenging moments. While the market is in a bull run, anyone can profit. Yet, those that have a long-term strategy that works are the ones who flourish and thrive when the market is tumultuous. Welcome to Lord Finance, where we are dedicated to helping you achieve financial freedom through education. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. Here are 10 golden rules of investing to follow to make you a more successful, and hopefully wealthy, investor. Rule 1. Never lose money. Now, let's start with some wise words from the late great investor Warren Buffett. Rule No. 1 is never lose money. Never forget Rule No. 1 is Rule No. 2. The Oracle of Omaha's counsel emphasizes how crucial it is to keep your portfolio from suffering a loss. Your portfolio will be more profitable if it contains more capital. A loss thereby reduces your potential earning capacity. Of course, saying that you won't lose money is simple. In essence, Buffett's rule states that one should consider an investment's drawbacks in addition to its possible rewards. The investment might not be worthwhile if the potential rewards don't outweigh the risk you're taking. First, concentrate on the negative, advises Buffett. Even if stock prices have fluctuated, they are reliant on the profitability of multinational corporations. Stocks will climb along with earnings, at least in the long run. Compare that to cryptocurrencies, which typically lack a foundation to support their price, such as earnings or tangible assets. That is, cryptocurrencies may ultimately be worthless, which is a risk that Buffett is not willing to take. Rule 2. Think like an owner. Think like an owner, advises Chris Graff, RMB Capital's co-chief investment officer. Remember that you are investing not only in stocks but in businesses as well. While many investors approach stocks like gambling, those stocks are supported by legitimate businesses. Stocks are a fractional ownership interest in a firm, and if the business performs well or poorly over time, the company's stock is likely to follow the direction of its profitability. When investing, Christopher Miser, CEO of Vivares Capital in La Jolla, California, advises being conscious of your motivations. Are you betting or investing? Make sure the management team is strong and aligned with the interests of shareholders, and that the company is in a strong financial and competitive position, says Graff. Fundamentals analysis, valuation, and a prediction of the company's future performance are all part of investing. Rule 3. Stick to your process. According to Sam Hendel, portfolio manager at Kepos Capital, the best investors develop a process that is consistent and successful over many market cycles. Don't deviate from the tried and true, even if there are short-term challenges that cause you to doubt yourself. One of the best investment tactics is the long-term buy and hold strategy. In a 401k, for instance, you can routinely invest in stock funds and retain them for years. Yet when the market becomes erratic, it might be simple to veer from your plan since you're momentarily losing money. Don't do it. Rule 4. Buy when everyone else is fearful. Investors frequently sell or simply stop paying attention to the market when it is down. Nonetheless, that is the time when sales are rife. It is accurate to say that the stock market is the only market where products are on sale but no one wants to buy. As Buffett has famously said, be fearful when others are greedy, and greedy when others are fearful. The good news for 401k investors is that once your account is set up, there is nothing else you need to do to keep investing. Your emotions are kept out of the game by this arrangement. When equities are less expensive and offer superior long-term values, you'll keep buying them. The same will probably hold true for future downturns. Investors that kept buying during the 2020 slump rode stocks up throughout 2021. Rule 5. Keep your investing discipline. Even if they can only save a small amount, Investors should continue to save over time, in both difficult and favorable economic conditions. You'll develop the habit of living within your means while amassing a nest egg of assets in your portfolio over time if you keep investing consistently. The 401k is the perfect vehicle for this discipline since it automatically deducts money from your paycheck without requiring your consent. Here's how to choose your 401k investments. It's crucial to choose your assets wisely. Rule 6. Stay diversified. Maintaining diversification in your portfolio is crucial for lowering risk. Holding just one or two stocks in your portfolio is risky, regardless of how well they have done for you. Therefore, experts suggest diversifying your money in a portfolio. Diversification, according to Mindy Yu, a former director of investing at Betterment, is the one approach to keep in mind when investing. Diversification can help you better withstand the ups and downs of the stock market. The good news is that diversity may be simple to do. A portfolio's diversification is accelerated by an investment in a Standard & Poor's 500 index fund, which contains hundreds of holdings in the best companies in America. If you want to diversify your investments even more, you can add a bond fund or other options, such a real estate fund, which may perform differently depending on the status of the economy. Rule 7. Avoid timing the market. Specialists frequently urge clients to refrain from trying to timing the market, or to purchase or sell at the ideal time, as is made popular in television and movies. The adage "time in the market is more important than timing the market" is frequently used instead. The premise behind this is that in order to earn good returns, you must stay invested rather than constantly entering and exiting the market. And that's what Veronica Willis, an investment strategy analyst at Wells Fargo Investment Institute, recommends. The best and worst days are typically close together and occur when markets are at their most volatile, during a bear market or economic recession. An investor would need expert precision to be in the market one day, out of the market the next day and back in again the following day. To benefit from dollar cost averaging, experts normally suggest making frequent purchases. Rule 8. Understand what you invest in. Don't invest in a product you don't understand and ensure the risks have been clearly disclosed to you before investing, says Chris Raleigh, founder and CEO at Harvest Returns, a fintech marketplace for investing in agriculture. You must comprehend how whatever it is that you are investing in operates. When purchasing stocks, it's important to understand why it makes sense to do so and when the stock is likely to perform well. While purchasing a fund, you should be aware of its performance history and expenses, among other factors. It's crucial to comprehend how an annuity functions and your rights if you're purchasing one. Rule 9. Review your investing plan regularly. Although it can be a good idea to create a strong investing strategy and just make minor adjustments to it, it's a good idea to routinely check your plan to ensure that it still meets your needs. This could be done each time you review your accounts for tax-related purposes. Kevin Driscoll, Vice President of Investment Services at Navy Federal Financial Group in the Pensacola region, advises clients to keep in mind that their initial financial strategy won't be their last. You should review your plan at least once a year, especially when you hit milestones like establishing a family, moving, or changing careers. Rule 10. Stay in the game, have an emergency fund. You must have an emergency fund in order to stay invested for the long run as well as to get you through difficult times. Maintain 5% of your assets in cash, advises Craig Kersner, President of Retirement Planning Services at Pompano Beach, Florida-based Kersner Financial Management. It makes sense to have at least 6 months' worth of expenses in your savings account, the author continues. If you have to sell any of your investments during a difficult time, it will probably be when they are at a loss. You may be able to continue investing for longer if you have an emergency fund. Short-term, less than 3-year, cash needs to stay in cash, ideally in a high-yield online savings account or possibly in a certificate of deposit, CD. To obtain the best deal, shop around. Effective investing involves both doing the right things and avoiding the incorrect ones. In the midst of all of that, it's crucial to control your fury so that you can inspire yourself to act morally even though it may feel risky or unsafe to do so. That's all for this video. See you in the next one.